When it comes to real estate investing, one of the most important decisions an investor will ever make is what type of property to buy. Two of the most popular options are single-family homes and multifamily properties. Single-family homes are often seen as simple, safe, and familiar. Multifamily properties are viewed as scalable, efficient, and more complex. Both strategies have produced millionaires. Both have also caused investors to fail. So which one is better? In this video, we will break down multifamily versus single-family homes, comparing income potential, expenses, risk, financing, scalability, management, and long-term wealth-building power. By the end, you will clearly understand which strategy fits your goals. Let's start with definitions. What is a single-family home? A single-family home is a residential property designed for one household. It can be a detached house, a townhouse, a condo, depending on local definitions. The key characteristic is simple: one unit, one tenant, one rent payment. Single-family homes are the most common entry point into real estate investing because they are easy to understand, easier to finance, familiar to most buyers. What is a multifamily property? A multifamily property contains two or more residential units under one ownership. Examples include duplexes, triplexes, fourplexes, apartment buildings. Multifamily properties generate multiple income streams from one property, which changes the risk and reward profile significantly. Income potential comparison: single-family home. Income: single-family homes generate income from one tenant. The rent is usually limited by neighborhood standards, comparable properties, tenant affordability. This creates predictable but capped income growth. If the tenant moves out, income drops to zero until the unit is re-rented. Multifamily income. Multifamily properties generate income from multiple units at the same time. This provides higher total cash flow, income diversification, stronger long-term upside. Even if one tenant leaves, the property continues producing income from other units. Multifamily properties benefit from economies of scale, where income increases faster than expenses as unit count grows. Vacancy risk in single-family homes. Single-family homes face binary risk. Either the home is rented and producing income, or it is vacant and producing zero income. A vacancy can completely eliminate cash flow for months. Vacancy risk in multifamily properties. Multifamily properties spread vacancy risk across multiple units. For example, a 10-unit property with one vacancy still operates at 90% occupancy. This creates income stability, especially during economic downturns. Vacancy is still a risk, but it is less destructive. Expenses and operating costs. Expenses for single-family homes. Single-family homes often have lower total expenses, simpler maintenance, fewer systems to manage. However, repairs can be more expensive per unit. One roof, one HVAC system, one major repair can wipe out several months of profit. Expenses for multifamily properties. Multifamily properties have higher overall expenses, more frequent maintenance, more wear and tear. But costs are spread across multiple units. Replacing a roof on a 10-unit building costs more than a house, but far less per unit. This improves long-term efficiency. Management complexity. Managing single-family homes. Single-family homes are easier to manage, less time-consuming. Simpler for beginners, tenant communication is limited, and property management is straightforward. This makes single-family homes attractive for investors seeking low involvement. Managing multifamily properties require more systems, stronger management, faster response times. Tenant issues multiply with unit count. However, once systems are in place, multifamily properties can be more efficient per unit than managing multiple single-family homes. Financing differences. Financing single-family homes. Single-family homes are easier to finance, eligible for conventional loans. Often available with lower down payments, banks view them as low-risk assets. This makes entry easier, especially for first-time investors. Financing multifamily properties. Multifamily financing depends on size. Properties with 2 to 4 units can still qualify for residential loans. 5 or more units are considered commercial. Commercial loans focus on property income, debt service coverage, operating performance. Down payments are larger, but loan amounts scale faster. Appreciation and value growth. Single-family home. Appreciation. Single-family homes appreciate based on comparable sales, neighborhood desirability, market trends. Investors have limited control over appreciation. Value growth depends largely on the broader housing market. Multifamily appreciation. Multifamily properties are valued based on net operating income, rental performance, expense management. This gives investors direct control over property value. Increase income, reduce expenses, value rises. This is one of the most powerful advantages of multifamily investing. Risk profile. Risks of single-family homes. Vacancy, risk, tenant non-payment, market-dependent appreciation, slower portfolio growth. Single-family homes are stable but can stagnate. Risks of multifamily properties, management complexity, higher capital requirements, operational risk, market sensitivity. Multifamily investing rewards skill and systems, but punishes poor execution. Scalability. Scaling with single-family homes. Scaling single-family homes often means buying one property at a time, managing multiple locations, increasing operational complexity. Managing 10 single-family homes often feels like managing 10 separate businesses. Scaling with multifamily properties. Multifamily properties scale vertically. One property can hold 10 units, 50 units, 100 units. This allows investors to grow income faster without multiplying locations and systems. Scalability is one of multifamily's strongest advantages. Exit strategies. Exiting single-family homes. Single-family homes have large buyer pools, strong resale demand, easier exits. They appeal to homeowners, investors, and institutions. Exiting multifamily properties. Multifamily properties are sold primarily to investors, institutions, funds. The buyer pool is smaller, but deals are larger and more strategic. Exit success depends heavily on financial performance. Lifestyle considerations. Choose single-family homes if you want simplicity, prefer lower risk, are investing part-time value flexibility. Choose multifamily properties if you want faster wealth building, can handle complexity. Think in systems, plan to scale aggressively. Which strategy is better? There is no universal winner. Single-family homes excel at stability, ease of entry, long-term appreciation. Multifamily properties excel at cash flow, scalability, value creation. The best strategy depends on your experience, your capital, your goals, your risk tolerance. Many successful investors start with single-family homes and transition into multifamily over time. Final thoughts. Single-family homes build a foundation. Multifamily properties build momentum. Both are powerful tools when used correctly. The key is not choosing the trendiest strategy, but choosing the one that aligns with your skills, resources, and long-term vision. Real estate success comes from clarity, discipline, and execution. Thank you for watching.